Hi everybody, okay, good morning and welcome to our second CPD session of 2023. I was just joking with our presenter this morning that he seems to be back by popular demand for a second time in a month. So for those who haven't virtually met me before, my name's Marie Wadeson. I'm a managing director at Quantum, and on behalf of our parent company, the K3 Capital Group, I'm responsible for the K3 Hub, which is a member network for professional advisors developed by us and other companies within the K3 Capital Group. Since we launched in the spring of 2021, over 2,400 like-minded professionals from across the country have joined our network, through which they can access a range of CPD and training sessions not dissimilar to today's event, and referral fees for certain types of work referred into the group. Today, we have the second of our 3-hour CPD sessions, the VAT, misconceptions and common errors. Before I introduce you to our speaker, we have got a few pieces of housekeeping. So we are recording today's session and the webinar will be on the K3 Hub website next week. Q&A function is open, so do feel free to ask questions as we go. One particular plea from our speaker, if you would be kind enough to use the Q&A function rather than the chat to ask your questions, just helps us manage those a little easier. I think I've had a few questions about slides already. I think the team in the background running this webinar have just posted them in the chat for you and you can download them from there. And I expect they'll post them a couple of other times throughout the session for those people who are running a bit late and joining us. I think we do have a couple of short breaks planned this morning. They'll be sort of there or thereabouts on the hour, sort of to fit in with the flow of the session. Okay, right, so on to today's session in that case. So very pleased to be able to reintroduce, for those that joined last time, our trainer today, Malcolm Greenbaum. Malcolm qualified as a chartered accountant in 1989, as a chartered tax advisor in 1995, and worked for BPP for 18 years. In 2008 even, he set up his own training and consultancy company, delivering accounting and tax courses to accounting firms and clients across a wide range of industries. Today's session will broadly cover supplies of services and the basic principles, cross-border VAT, differences between business and non-business customers, special rules and misconceptions of meaning of certain phrases used in the law. Very final quick note from me. Our next structured CPD session is running next Friday morning at the same time. It'll be a HR and employment law update, which is always a very popular subject with our members. If you haven't already had your invite, do let us know in the chat and we'll get that out to you, but you should have had those invites by now. And that's it from me. Have a great weekend when it gets there, but Malcolm, over to you.
Thank you very much, Maria. Very good morning to everybody. Welcome to part 2 of our look at VAT issues and misconceptions. We didn't get to the sort of end of the material last time. There were a lot of questions being asked, which I would encourage again, please. And I'd much rather I answered your questions and we didn't actually finish everything we were supposed to cover than to just rattle through it. And you get no opportunity to give me scenarios or questions that you need answers to. So please keep the questions coming. But as Marie said, if you could post them in the Q&A as opposed to the chat, it just makes life a bit easier for me because I only have to look at one box rather than looking at 2 separate boxes. And also the Q&As, we can clear the questions down once they've been answered. Otherwise, I end up with a whole screen of questions and never too sure which ones I've answered and which ones I haven't. So welcome. If you didn't come to part 1, welcome back if you did. There are a couple of areas of property VAT, which we didn't actually finish last time. So although the main focus of this morning will be on cross-border VAT and the misconceptions around that, I do want to just finish off those areas of property VAT because I think they are pretty important. And in fact, I've had a question even before the session began, a question been sent through to me by K3, which is focused on some of the stuff we're going to talk about first thing this morning. So the person who sent that question in, I've got it here, so you don't need to ask it again. And once we've covered the relevant technical material, I'll explain the question. In fact, what I might do is just copy and paste the question into the chat so that you can all see it, all read it, and then I'll talk my way through how we resolve the VAT implications. So we're going to start with a bit of property VAT and then move on to cross-border services. As Marie said, we'll probably stop after about every 50-55 minutes to have a 10-minute break. I don't know whether it will take 3 hours to get through the rest of the material we were scheduled to cover last time, but if we do finish a little bit early, then obviously there's the opportunity that you can ask any more questions that you wish to ask towards the end. So let's begin. We finished last time talking about options to tax when it comes to property. So let me just row back slightly, because I appreciate that some of you may be joining today who didn't join last week. Sorry, last time, not last week, last time. And just briefly remind people about the fundamental VAT implications of land and buildings transactions. And what I said first and foremost was that unlike every other type of supply in VAT law, if the legislation doesn't mention the VAT rating of a land and buildings transaction, then the default is that it's an exempt supply. In every other field, if the legislation doesn't mention the VAT rating, we always say that it must be standard rated, because the legislation tells you in Schedule 7A which supplies are 5% rated. In Schedule 8 of the VAT Act, it tells you which supplies are 0 rated. And in Schedule 9, it normally tells you which ones are exempt. So everything else is standard. But if you look at Schedule 9 Group 1, land and buildings, it actually tells you which ones are specifically standard rated. So everything else is exempt. So broadly speaking, in the absence of an option to tax, sales of bare land are exempt. Charging rent is exempt. Granting a lease is exempt. Assigning a lease is exempt. Granting any right over land would be exempt unless it's covered by a particular rule. We also learned that if builders, plumbers, electricians are constructing new dwellings or new residential purpose properties like care homes, then they would 0 rate their supply. That would be 0 rated. And we also talked about the first grant of a major interest in a care home or in a dwelling, once it's been completed, is also 0 rated. And we said that a major interest is either the sale of the freehold, or it's a granting of a lease that exceeds 21 years, or in Scotland, 20 years. Now, that was 0 rating broadly. And then we talked about reduced rating, where there are qualifying conversions and qualifying renovations. A qualifying conversion, one type is a change in the number of dwellings conversion. So a barn conversion is one of those, because you go from 0 dwellings to 1 dwelling afterwards. So a builder would charge 5% VAT on their supplies to turn a barn into a dwelling, into a house. Converting a house into flats would also be 5% rated. Converting flats back into one house would also be 5%, because it's a change in the number of dwellings, up or down, doesn't matter. The other type is qualifying renovations, and that's all about just about dwellings. So with dwellings, if the property has been empty for 2 years, then the builder can charge 5% VAT on the renovation costs. And when it comes to property developers renovating buildings or dwellings that have been empty for 2 years, the only condition is that the building was empty for 2 years when the work began. So I could buy your flat, your house from you today as a developer. I could leave it empty for 2 years and then renovate it. And the builder would charge me 5% VAT if I gave them proof that it had indeed been empty for 2 years. And what I said last time was that once you've established that the renovation is 5% rated, you can actually extend that property at the same time, and that would also be 5% rated. And that's really important, because I mentioned that Schedule 9 Group 1 of the VAT Act, which normally deals with exempt supplies, tells you which supplies are explicitly standard rated, and enlargements of properties are explicitly standard rated. So unless they're covered by some other special rule, a builder who carries out an extension has to charge you standard rated VAT. And I said the standard rated VAT apply to repair, renovation, enlargement, etc., alterations, unless it's covered by a special rule. And other standard rated supplies, the construction of a commercial building is specifically standard rated. So the builder would have to charge VAT when they are constructing a commercial building, office, warehouse, factory, that sort of thing. And also the sale of a commercial building, which is either incomplete, it's not finished yet, or it's within 3 years of the property being completed, any supply during that 3-year period is automatically standard rated. Anything to do with holiday accommodation, be it caravans, tents, or just simply renting out your own home for holiday use while you're away on holiday. So advertising your home on Airbnb, and when you're away, renting it to somebody for their holiday, that's also a standard rated supply. We then went on to say, fine, then by default, land and building supplies are exempted. They're exempt supplies for VAT purposes. But if somebody who has an interest in that property opts to tax the property, then that would generally turn what would otherwise be an exempt supply with that property into standard rated. So if, for example, I owned an office building and I was renting it out, well, I mentioned right at the beginning of today that renting out property by default is an exempt supply. It's not mentioned by the law. But if I opt to tax my interest in that building, then I would charge VAT on the rent. But having opted to tax my interest in the building, when I come to sell it, I've generally got to charge VAT on the sale. It does mean that I can recover any input VAT that I'm incurring because I'm making taxable supplies. Whereas if I was just renting out without having made an option to tax, then I'd be making exempt supplies. And if you only make exempt supplies, you can't register for VAT, so you can't get any VAT back in that situation. And we were just about to talk about when the option to tax actually gets disapplied. So somebody has made a valid option to tax. When do we ignore that option? So that's where we're starting this morning. So first things first, you can make an option to tax over any building or any piece of land you like. But if that building is being used as a dwelling, or if it's being used as a relevant residential building, so a care home, or it's being used for relevant charitable purposes, then the option simply has no effect. So if I opt to tax a warehouse, and then part or all of that warehouse is being used by a charity to store the goods it needs to fulfill its charitable purposes, if I've opted to tax the warehouse, then I mustn't charge VAT to the charity. That's an exempt supply. Despite the option, that's an exempt supply. The rest of the warehouse, if I partition the warehouse off into different spaces, the rest of the warehouse that I rent to other people, if they're not charities, I've got to charge them VAT. So as a landlord, I end up becoming partially exempt, which has its own implications, as I'm sure you're probably aware. If I opt to tax my home, my office is in my home, so I opt to tax this building, I can do that. I can send my form in and HMRC will acknowledge the option. So if I opt to tax my home and then, I don't know, we move out and rent it out, while we're renting out as a home, so while there are people living in it, we mustn't charge them VAT. There's an option to tax over the property, but we can't charge them VAT. But if, for example, we got planning permission and for whatever bizarre reason decided it would be a great commercial idea to convert it into some sort of business premises, maybe, I don't know, a dentist would use, then if a dentist came in and we had opted to tax the house, we would have to charge the dentist VAT on the rent, which wouldn't be very popular because dentists, the vast majority of their supplies are exempt supplies. They fall within the health and welfare exemption in Schedule, sorry, I've lost the ability to speak, in Schedule 9, Group 7, apologies, Schedule 9, Group 7. So they wouldn't appreciate being charged VAT on the rent because they couldn't really recover it. They might be able to recover a small amount, but almost certainly not. So options to tax have no effect over dwellings, no effect over a property which is being used as a care home, and no effect over a property which is being used for charitable purposes. But there's a subtlety here, because if the charity is using the space as an office, as a back office, as an admin office, then they're not using that office for charitable purposes. They're using it for administration. And I would have to charge VAT on that rent. Now, what if they're using part of the space for charitable purposes and part of it is for administration? Then the option to tax only applies to the part of the space they're occupying, which they're using as an office, as an admin office. The space they're using for charitable purposes, I mustn't charge VAT on. And as a landlord, I would have to apportion the VAT. So it's a very important point. I've often had charities write to me and say, I do quite a bit of VAT work with charities. They write to me and say, our landlord has written to us saying they're opting to tax this building and we rent some of the space in that. Is that going to cost us more money? And the answer should be no. But they should be writing to the landlord straight away saying, we use this building for charitable purposes, don't charge us VAT. Just to make sure. So that's one situation where the option to tax made by a person, a company or an individual over a property is ignored. There are two other situations, one of which is really, really important. The first one, however, let's say that you're looking to buy land, bare land. Now, if the person who has the interest in that land, the owner of the land, has opted to tax that land, then ordinarily they've got to charge you VAT when they sell it to you. But if you say to them, the reason why I'm buying this land is because I want to build a house on it and I'm going to move into it, it's going to be my dream home, then you can ask the vendor to set aside the option, to ignore the option in the transaction. The vendor does not have to agree. The vendor can turn around and say, I'm sorry, there's an option to tax, I want to charge VAT. And if you want to buy this land, you've got to pay VAT. And if you don't want to pay VAT, I'll find someone else to buy the land from me. Similarly, if a housing association approaches a landowner and the landowner has opted to tax the land, the housing association can say to the vendor, I want to buy your land to build social housing, but I'll only buy it if you set aside the option for this transaction. And again, the vendor can make a decision whether they want to or not. But if they agree to set aside the option, then if that's contained within the contract, then that's it. The sale of the land and the purchase of the land is an exempt supply. And that saves the purchaser 20% VAT, which they wouldn't be able to recover. When you build your own home, you can recover VAT on the building costs, but you could never recover it on the land. In addition to the VAT that you'd pay, you also pay stamp duty land tax on the consideration you pay for the land. And if that includes VAT, then so be it. So if I buy some land for £500,000 and there's no VAT, I pay SDLT on £500,000 at commercial rates. But if the vendor has opted to tax the land and I haven't been able to convince them to set aside that option, then the land is actually going to cost me not 500 grand, but 600 grand because of the VAT. And I'll have to pay SDLT on 600 grand. It's going to cost me an extra probably 5% SDLT on an extra 100 grand of purchase price. It's going to cost me an extra 5 grand in SDLT, as well as the 100 grand extra. Now, just a couple of questions come in before I continue. Sorry, just before I cover those questions, apologies to those who've asked them, but I'll be there shortly. There's no real reason why the vendor of bare land would necessarily object to being asked to set aside the option in the appropriate circumstances. Okay, it might be that as a result of this, because they're making an exempt supply of land, it means that any directly related input that they incur, like agents' fees, estate agents' fees, land agents' fees, and professional fees like lawyers' costs, they wouldn't be able to recover the VAT on that. but that probably wouldn't be a massive amount. And the vendor is entitled to turn around to the purchaser and say, look, yeah, okay, we will set aside the option, but that's going to cost us some irrecoverable input VAT. So how about the price goes up by a couple of £1,000? So you can have it without VAT, but I'm going to charge you a couple of grand more. Well, that's a damn sight better for these purchasers, you to buy your home, to build your home, or a housing association to build social housing, than having to pay 20% VAT on top. Now, a couple of questions come in. Thank you, Stephen. So the question is, if a landlord charges VAT on rent to my client, and my client does not opt to tax, that's the scenario. Okay, that's the scenario. So, okay, can I just address that one point to start with? I'll get to the rest of your question in a moment, Stephen. But let me answer that one point. If my company, which only ever makes standard rated supplies, if my company was to buy an office from a vendor, and the vendor has opted to tax, so they're going to charge me VAT on the price of the office. If it's more than 3 years old, they're going to charge me VAT. I don't have to opt to tax that property to claim back the VAT. This is a very common misconception. So it's useful discussing it in a course that's called VAT Misconceptions. So recovering VAT on a property is just like recovering VAT on anything else. So if my company went out and bought a laptop, or it bought a new printer, or it bought some stationery, it's going to pay VAT. And because my company only makes standard rated supplies, it can recover all the VAT. It's the same thing with a building. If my company buys a building and it only ever makes standard rated supplies, it recovers the VAT in the normal way, just puts it through the VAT return of the period, the quarter, when it purchases the property. We're going to look a bit later on about something called the capital goods scheme. We've got to keep an eye on that VAT, because if we started making some exempt supplies, that might change things. But if a commercial business purchases land for its business use, or it purchases buildings for its business use, then it recovers VAT on the buildings initially in the normal way. It doesn't have to opt to tax. So that's just a point I wanted to get over. Now, so Stephen says that a landlord is opting to tax, they're charging VAT on a property, presumably it's a commercial property, and your client doesn't opt to tax. Fine. They don't have to necessarily, unless they would be doing something exempt with the property. So he goes on to say that part of the space is the shop that the client uses, and the rest is sublet. So part of it's sublet, and part of it is used in their business. I presume, Stephen, that the business is a standard rated or zero rated. It's not an exempt business, it has no exempt supplies. So unless that's not correct, sorry, if that is incorrect, let me know. If it's correct, don't worry. Can my client claim input VAT on any rental charge to them and any costs relating solely to the shop? Well, the answer is yes. So your client, if they don't opt to tax their interest in that property, they would be able to recover input VAT based on the proportion they use that building to make taxable supplies. Now, you didn't say how much they paid, how much rent they're paying, but it doesn't really matter. They should be able to claim a proportion of the rent charged. Now, generally speaking, you might base that on the area, the floor area that's occupied by the shop, compared to the floor area that's rented out. That would be a fairly sensible way to do it. But Stephen, your client could, it depends who's renting the rest of it, but your client might consider opting to tax their interest in the property as a tenant. And then when they sublet the space to their subtenant, they would charge VAT on the sub-rental. And that means that they can recover all of the input VAT charged by the landlord. So they can definitely at the moment get back some of the VAT, but if they were to opt to tax the property and charge VAT on the rent they're charging to the subtenant, they could claim all of the input VAT back on the main rental. Simon, option to tax will enable one to reclaim the input VAT, but depending on use, one will need to charge VAT. I'm not entirely sure that I understand the question, if I'm being honest with you, Simon, but I think later you said that you now understand the answer to your own question. The answer is you don't actually need to opt to tax to reclaim the VAT, which I think is probably what you've gleaned from what I said earlier. As long as you're using that building to make taxable supplies, you can recover that VAT. Hussein, hello, sorry, just to confirm, please don't be sorry, by the way. Yeah, just ask the question. There's no need to be sorry. I actively encourage it. So just to confirm, if a building is designed as a dwelling, but rented out for business purpose and not for residential purposes, would the option to tax have effect on such a building? Hussein, based on what I just said before, what do you think the answer is? Just type it in the Q&A because only I will see it. But what do you think the answer is? It's designed as a dwelling, but it's rented out for business purposes. And if you've opted to tax the dwelling, would you charge VAT? Just type in what you think the answer is, Hussein, to me, just in the Q&A, because only I will see that. Correct. Yeah, the option to tax has effect. Once you've opted to tax a property, then you charge VAT unless it's one of the situations where you ignore the option. So while that dwelling is being rented out as a dwelling, while people are living there as their home, you can't charge VAT. You mustn't charge VAT. But once you start renting it out for business purposes, then that is no longer being used as a dwelling. So if you look at my slide, the top point on my slide, then that falls away and you have to charge VAT. So you are correct, Hussein. Absolutely correct. Well done. Very good. Right. Let's move on. Razakul, you've got your hand up in the meeting. So I'm not sure if you wanted to ask anything or whether that's just a mistake. Next point. Just following on from the previous one, that if a vendor has opted to tax bare land, they have to charge VAT on it, unless I come along and say I want to buy it to build my home. Would you mind not charging that? And if they agree, then the supply reverts to be an exempt supply because we ignore the option to tax. But the second one, the third bullet point on here is probably the more common situation. Christian, I'll come back to a question just in a moment, if you don't mind. I'm on a roll. So if the building, yeah, no problem, Razakul, you don't need to apologise. If the building, so I own a building and it's not a dwelling, it's not a residential purpose, it's not a care home, and it's not being used for charitable purposes. So it's a commercial building and I have opted to tax it. I've opted to tax my interest in it. And somebody comes along to me and says that I want to buy your building, but I want to convert it into dwellings, or I want to convert it into charitable use, or I want to convert it into a care home, some sort of residential purpose property. Then the same thing can apply. They can send me a form this time, and then the first one with the land, there's no form, but here they send me a form. It's a form 1614D. All the options tax forms are form 1614 something, to tell me that they intend to use this as a dwelling. So they're going to convert it into a dwelling, convert it into a care home, convert it into charitable use. Would I mind setting aside the option I have in place? And it follows the same sort of approach as the land. If I agree, if I say, yeah, okay, if you're going to be converting this into one of those properties, then if I agree not to apply the option, so I disapply the option, then assuming this commercial building is more than 3 years old, I would be making an exempt supply to the purchaser. An exempt supply to the purchaser. Now, if I don't agree, I just turn around to them and say, I'm going to charge you VAT. Do you want to buy it? or don't you want to buy it? Now, let's just reflect back on what we covered last time in the area of property VAT, and I'll try and walk you through what would happen in that situation. So let's say that you are a property developer, and I am the person with this office building, let's say, and you are looking to buy the office building from me because you want to convert the office building into flats, let's say apartments, which you are going to sell once they are finished, once they're complete. So let's talk through all of the VAT implications of that. Let's assume that I refuse to set aside the option because it's my choice as the vendor. If you buy this building from me, you're going to have to pay VAT. Now let's think about whether you could recover that VAT. So I need people to give me answers. You can either, Sunil, can you please put your questions in the Q&As rather than the chat? It just means I'm looking in one place rather than the two. It's much less confusing. If you don't mind, please, if you don't mind. But can you please use the chat facility, not the Q&A, and tell me if you're going to be converting these buildings into dwellings, can you tell me, first question, if you engage a builder to do that conversion work, what rate of VAT will the builder charge you for that work? Okay, fantastic. Right, now, most of you have given me the right answer, which is that you'll be creating new dwellings that weren't there before because it was an office block. So you'll be changing the number of dwellings. It's like a barn conversion, but on a grander scale. So therefore, the builder would charge you 5% VAT. You're quite right. Now, James, just to understand, you only get zero rating. You can only get zero rating when you are building from the ground up. Okay, from the ground up. So if you were to demolish the office block and you were to build a brand new block of flats, you would be correct. It would be zero. But if you're just converting what's there, where I live in Edgware in Middlesex, I stare out my office window and I can see a development where the office block is being converted into flats. So they haven't demolished the office block; it's always been there, but they're just fitting out as flats and as apartments now. So that's fine. You can never get zero rating if you're doing something with an existing building. You only get it when you're starting from scratch. So I hope you'll take that idea forward to your future advice. Excellent. So you've bought the building, the office building from me. You have got it converted. So you've charged 5% VAT. And now you're going to sell those apartments when it's finished. Can you use the chat facility, please, to tell me what VAT rating you think will apply to the sale of those dwellings? Okay, so I've got a lot of offers of zero and one offer of exempts and one offer of standard rated. Okay, so so I've got 0, 20 or exempt. So at least nobody said 5%, which is great. Yeah. Now, first things first, and this is all about dispelling misconceptions. So I'm delighted that some people haven't got the right answer because it means you'll learn something. Just make sure when you give advice, you give the right answer. Now, dwellings can never, ever be standard rated. Never. Dwellings, when you sell them, can only either be zero or exempt. And we covered last time, so those of you who weren't here last time, don't worry about this. But last time, what I said was that zero rating applies to the first grant of a major interest in a dwelling once it has been completed. Okay, once it's been completed. Now, there weren't any dwellings there before. It was an office block. So you've created dwellings out of nothing, and now you're selling them for the first time. So the sale will be 0 rated. Okay, the sale will be 0 rated. It's the first grant of a major interest in those dwellings since they were completed. So 0 rated. Now that's important. You're going to make a 0 rated supply when you sell these flats, when you sell the freehold, or when you grant a more than 21-year lease in the flats. Well, if you're making a 0 rated supply, then you can recover the input VAT. You can recover all the input VAT you've incurred. You can recover the 5% for the conversion costs. You can recover the 20% that I'm charging you to buy the office block in the first place because I opted to tax the office block. So if you're going to be if you're going to convert this office into flats and then sell them and make a 0 rated supply, why do you care about asking me to set aside my option? Which is what you can do in this third bullet point. Why not just pay the VAT and recover it? Nina, perfect, because of cash flow. Absolutely, because of cash flow. That's one good reason. Because you've got to pay me the gross amount and then claim the VAT back. But James has the answer I was looking for, which is SDLT. That if you allow me to charge you VAT, even if you can recover that VAT, then it's going to cost you more SDLT, and you can't recover SDLT. You can recover VAT, but you can't recover SDLT. So it's another cost that you have incurred. Hussein, very good. This is going back to last time's training. I'm glad you remember this. Hussein is making the point that you can't recover input VAT that has been incorrectly charged. That's quite right. But if I refuse, in this third bullet point, if I refuse to set aside the option, I am correctly charging you VAT. You can ask me to set aside the option, but I don't have to. So if I don't have to, then I'm charging VAT perfectly correctly. Does that make sense, Hussein? I'm really glad you brought that point up because it's a very fundamental point. But in this case, there's no error. Yeah. To be honest, Hussein, I'm telling you I'm charging you VAT. That's got to be correct because I'm teaching about VAT. Okay, so it's definitely correct. And that's because this is a choice that I have. Yeah, it's a choice that I have. Excellent. Now, I will come back to these questions in a moment. I do apologize, it's taken a bit longer than I was hoping, but I wanted to talk through that scenario because that's the sort of thing that you would have to think about if you're giving VAT advice. Just think through the supply chain. Okay, we're being charged this VAT for that, this rate of VAT for that. We're going to do this at the end, going to sell at the end or whatever. What's the VAT rating at the end? Because that will inform whether you can recover the input VAT along the way. Now, going back to this third bullet point, and I will come to these questions imminently. It works like the land transaction before, that if you ask me to set aside the option and I agree, then we write that into the contract. So it has to be done before the contract is exchanged, really, because that binds me in my decision not to apply the option. However, there is a second chance that if it hasn't been done by exchange, then you can ask me between exchange and completion whether I would set aside the option, but now you can't force me to. Once it's written in the contract, that's it, done and dusted. But if you forgot to do that, you can appeal to my better nature. Would you mind, we forgot, but would you mind, before we complete, would you mind setting aside the option and making it an exempt supply? And I could turn around and say yes or no. It's entirely my choice now because the contract doesn't make any mention of it. The problem with the building example, as opposed to the land, is something called the capital goods scheme. Something called the capital goods scheme. And the person who sent me the question before the course, that has a role to play in the answer I'm going to give you a bit later on. Now, we're going to talk about the capital goods scheme momentarily, but I would just say that, broadly speaking, if you or a client purchases land or buildings on which you have been charged VAT, then we monitor your ability to recover the VAT over a 10-year period, which I think I mentioned briefly last time, over a 10-year period. The really important thing, I think, is that if I recovered the VAT at the beginning, because I used the building to make wholly taxable supplies, and then let's say 7 years later, I sell that building to you, okay, sell the building to you, then if I haven't opted to tax it, or I have opted to tax it, but you've convinced me in this third bullet point here, you've convinced me and I've agreed to set aside the option, and that's written in the contract now, I have to go along with that. Yeah, I don't have to per se agree to do it, but once we've agreed I'm going to do it and it goes in the contract, that's it, I'm bound by it. The problem that creates is that under the capital goods scheme, if I sell that building on which I recovered input tax originally as an exempt supply, then for the remainder of this 10-year period over which we judge our ability to keep the VAT that we've recovered, it's presumed that had I kept the building, I would have used it wholly for exempt supplies for the remainder of that 10-year period. In fact, just the remaining number of whole years left of the 10-year period. So in very simple terms, if I bought this office building for £1 million plus VAT, and I recovered the 200 grand VAT 7 years ago, because I'm using it for my training consultancy business, which is just making standard rated supplies, and then 7 years later, I sell it to you and I disapply the option that I've got, because you've asked me to, and I very generously agree, I've made an exempt supply. Broadly, 3/10 of that original input VAT, I have to pay back to HMRC. Having recovered the 200 grand 7 years ago, I'm going to have to pay back 30% of that 200 grand, 60 grand. Because it's presumed that I would have used the building, if I kept it, I would have used it to make exempt supplies for the next 3 years, hypothetically. Because I've sold it as an exempt supply, because I've set aside the option that I had to please you. Now, if I don't know that impact, if I don't know about VAT, and you come to me and say, would you mind not charging me VAT? And I say, yeah, okay, I can do that. Yep, I'll exempt supply. That's just cost me 60 grand. But if I know that that's what's going to happen, I can turn around to you and say, I don't mind setting aside the option, but it's going to cost me 60 grand. So if you want me to do that, I'm going to increase the sale price by 60 grand. And that's why you have to have knowledge of VAT when it comes to purchases and sales of things like land and buildings. Because for the unwary, they can quite easily fall into a trap which inadvertently costs them a mountain of VAT. Now, I'll just answer, there's a question that's come in. What if I sold 11 years after displaying the option? Billy, the option only, the capital goods scheme, so judging the input VAT recovery, only lasts 10 years. Once you've had the building for 10 years, since the expenditure was incurred, then the capital goods scheme drops away. And so any VAT you've claimed back validly, you keep. So after 11 years, I could disapply the option, make an exempt supply, and it would have zero effect on the input tax recovery from 11 years ago. Okay, let's deal with the questions that have come up. Ian, you put yours in the chat. If you wouldn't mind putting your questions into the Q&As, that would be great. I asked you to answer questions in the chat because it's just much quicker for me to see the answers come through. And the people in the background dealing with the questions don't have to then delete all of them. So, Ian, can I explain the force you to display the option points? Yeah, absolutely. So under the second and third bullet points on this slide, you can ask me if I am, please stop, everybody, please stop apologizing, okay? It doesn't matter. Under the second and third options here, I've opted to tax. You can ask me if I would set aside that option in these valid circumstances. I can say yes or no. I have the choice as to whether I do so. And if I say no, I'm not going to set it aside, then that gives you a choice. You either go ahead with the deal and pay VAT, or you find some land or buildings somewhere else. But once I have agreed that I will set aside the option, and that gets written into the contract for sale, I am bound by that. I'm bound by that. And of course, you can then enforce that contract obligation. So I can't, after exchange of contract, back out of it, because it's in the contract. But if you forget to ask me to set aside the option before we exchange contracts, you have the opportunity to ask me between exchange and completion, but because it wasn't written into the contract, I can simply refuse. And because you've signed the contract, we've exchanged contracts, and you haven't told me in the contract to set aside the option, then I can simply turn around and say, look, here's the bit of paper, you agreed to buy it, here's the price, it's 2 million plus VAT. Give me 2.4 million. And you have no choice at that point but to pay it. But out of the goodness of my heart, I could turn around and say, look, I know it wasn't written in the contract, but you've come and asked me now, we haven't completed yet. Out of the goodness of my heart, I will set aside the option, but you can't force me to do so because it's not in the contract. Correct. Ian, correct. Okay, let's get back to the questions. I apologize, Christine, Tom, Sunil, you asked questions a little while ago, but I wanted to just bring this point out. Okay, so Christine, new management company for a property. They're using bills in our name to claim VAT. Ooh. Bills in our name. What does that mean? Bills in our name to claim VAT. Oh, I see. So there, Christine, let me know if I've got this wrong. But you're saying that there's a new management company for a property and they're claiming back VAT on invoices that are in your name. Is that right? Okay. Yeah, that's problematic, I have to say, because you can't claim back VAT unless you received that supply. And I mentioned last time we met that if the invoice is in the name of a different entity, then the presumption is that the supply was made to the entity to whom the invoice was made out. So I think probably what should happen, if they really are the ones that are incurring those costs and are entitled to recover the VAT, if the bills are being sent to you, then you should be recharging them to the management company. If that's really what's happening here. If essentially you're receiving the supply from the suppliers, but that's really their expenditure, then you should be recharging it to them. You should be raising invoices to them to recharge them. So for you, that's VAT neutral, because you'll claim back the input VAT on the invoices you receive, and you'll charge output VAT on the invoices you're sending. And they should then be able to recover input VAT on the invoice that you send them, as long as you haven't seen the invoice. What do you mean the invoices go straight to them? Ah, right. Yeah. Christian, I think we might have to take this offline because I'm a bit unclear about the scenario here. I apologize. Yeah. So they're getting the invoices, you're not. They're in your name. but they're claiming back the VAT. Doesn't sound like they should be recovering the VAT, no. Yeah, but it does sound like you might be able to recover that VAT if they're being addressed to you. Okay, Tom. A property is opted. Oh, Tom, just be very careful with your wording here. There's no such thing as a property being opted. We did discuss this last time, but it's a couple of weeks ago now, if not more. So a person opts to tax their interest in a property. So there can be more than one person that has opted to tax their interests in the same property. But anyway, somebody has opted to tax their interest in a property, and the tenant has a lease in place. Okay, so I presume the landlord is the one that's opted to tax, and the tenant has a lease in place. Does that mean that the tenant has sublet it, or they're renting it from the landlord? I think it means they're renting it from the landlord. So if the tenant then sells the lease, would the premium have to have VAT charged on it by the tenant? Very good question, Tom. This comes back to the point I just made, which is that a person opts to tax their interest in a property. Now, that means that in this case, the landlord has opted to tax their interest in the property. I presume it's a commercial property, and they've charged VAT. Okay, they've charged VAT correctly on the rent. Your client, if your client is the tenant has to make their own mind up as to whether they're going to opt to tax their interest in the property. If they don't opt to tax their interest in the property, and then they sub-rent the property, they are making an exempt supply of rent, because that's the default treatment for rent. But if the tenant has opted to tax their interest, as well as the landlord, then the tenant would charge standard rated VAT, assuming their subtenant was a business and wasn't a charity or something. Sunil, if an owner, individual or company is based overseas and they're running a furnished holiday letting in the UK, am I correct in thinking the VAT threshold does not apply and they have to register and charge VAT from the outset? Yeah, Sunil. Good question. So your client is overseas. They own a property in the UK, and that property is being rented out for furnished, for holiday lets. Doesn't have to be FHLs, but for holiday lets. So this brings out a point that will come out later anyway in the slides. If a person doesn't have an establishment in the UK, then they cannot benefit from the UK VAT registration threshold. Now, just owning a property you rent out is not enough to give you an establishment, a permanent establishment. So generally speaking, Sunil, you're right. They don't have the benefit of a VAT threshold, and they should be charging VAT for every pound of rent they're earning. However, HMRC accepts that if they are using an agent in the UK to rent out that property, then the fact they have an agent in the UK creates a permanent establishment, and then they would have the benefit of a VAT threshold. So they wouldn't have to charge VAT if the total rent from that holiday letting was less than £85,000 a year. So the answer is, it depends on whether they have an agent in the UK. Billy, I've answered your question already. So Kaushik. So in the example where we disapplied the option on a commercial property and was done in error, and the buyer can be got to agree to increase the price for VAT, is that possible? Kaushik, I'm not sure how you can disapply an option in error. I'm not sure how that can apply. I can't see how that can work, Kaushik. Either the vendor agreed to disapply the option, or they didn't. Now, if they've agreed to do it, and that's been written into the contract, then that is pretty much the end of the matter. Yeah, that's pretty much the end of the matter, actually. Sorry. Once it's in the contract, that's it. Done. The fact that might have been done in error, well, the question, what do you mean by done in error? if they did it and they should never have done it because the circumstances didn't fit this legislation, then of course what they've done is wrong and we have to apply the correct VAT treatment. But if they just decide it was a bad, if the purchaser just decides that it was a bad idea to do this, no, once it's in the contract, that's it. James, what if after agreeing the form 1614D, so this is the building example here in the slides, and the building is purchased, the developer changes his mind and does no work. Markets down, decides to sell the building. Does that affect the original purchase? Interesting. It is based on intention. So actually, James, what would probably happen in that situation is that the purchaser has now got a change of intended use of the building. So the vendor wouldn't have any comeback on this. The vendor has quite correctly made an exempt supply because they reasonably believed that that's what the purchaser was going to do with the property. They got the form in their hands verifying that. But what will probably happen in that situation, James, is that the purchaser would have to self-assess standard rated VAT. They have to charge themselves VAT to declare output that to HMRC, and then try and perhaps recover that, if they can, as input VAT, if they're still going to be using the building to make taxable supplies. So, James, in that situation, the liability then falls onto the purchaser. So if that should be charged, because they're not going to convert it for valid use, then they charge themselves VAT. Hussein, in order for the overseas entity to create an establishment in the UK, do they need to have any estate agent company who's managing it, or does it have to be an agent who exclusively works for the overseas business? Good question, Hussein. Because under general principles of permanent establishments, a dedicated agent creates a permanent establishment. But Hussein, HMRC accepts that if you have a property agent in the UK who's looking after that property for you, they don't have to be an exclusive agent. And for VAT purposes, you will have an establishment in the UK, so you can use the VAT threshold. Okay, excellent. Excellent. Right, I think we'll stop for our first break at this point. We've got through the first slide, which is impressive, in 1 hour, but there's a lot to talk about here because I wanted to recap land and buildings. And as always, you've asked me lots of questions to try and clarify your knowledge, which is fantastic. Welcome back. We'll try to cover more than one slide in this session. Sunil, you've asked a follow-up question about your UK holiday property. So does a marketing agent like cottages.com count as an agent? No. Sunil, what you need is a managing agent in the UK, someone who manages the property. I understand that cottages.com is just a way in which you can sell rental. So you just advertise the property through them, and then they sort of put you in touch with whoever wants to rent it. That's not an agent in the terms I was trying to explain. You need a managing agent in the UK. Someone's going to almost like go into the property, check it, make sure everything's okay, welcome new tenants, change the bedding, do the cleaning, whatever. So yeah, more than just cottages.com, I'm afraid. Sorry. Right, let's continue. Let's continue. When can you revoke an option to tax? There is a cooling off period, and the legislation actually does call it a cooling off period. The option can be revoked within 6 months of having been made, providing that you haven't made any taxable supplies during the period, because that could lead to the recovery of extra input VAT. And if you're now going to revoke the option, then maybe you shouldn't have claimed back that input VAT in the first place. Secondly, during that 6-month period, you haven't transferred the property as a going concern, which we'll talk about in a moment. Thirdly, you notify HMRC of your wish to revoke the option using Form 1614C. You generally have to get HMRC's permission to revoke the option. You can't just revoke it yourself. When you opt to tax a property, you simply tell HMRC that's what you're doing. You notify them that's what you're doing. It generally doesn't need permission. But when you're revoking, you generally do need permission, unless you haven't, and nobody associated with you has recovered any extra input VAT during that 6-month period when the option was in place. Or if they have recovered extra VAT as a result of this short-lived option, they would now be obligated to repay it. Or, strangely, I've never seen this in practice, by the way, or they did recover extra input VAT during the short life of the option. That was entirely on one capital item, one fixed asset, and it amounts to less than 20% of the total input VAT that was charged on that item. So there's like a de minimis amount of input VAT on one item that you can keep. But I've never seen that actually in practice, ever. So that's the first one. Within 6 months, you can revoke, although you probably need to get HMRC's permission to do so. They'll want to make sure you didn't recover any extra input VAT as a result of the option. Secondly, and this is another misconception people have, the law says that if you haven't had an interest in land or buildings for 6 continuous years, the option then generally lapses, just lapses, disappears. And that means that if you have opted to tax your interest in a property and then you sell the property, your option stays in place for the next 6 years. So if you ever did something with that property after selling it, for example, you rented some space from it and then sublet it, you'd have to still charge VAT. People think that once you've sold the property, your option is just torn up and thrown in the bin. It is not. It takes 6 years after you've sold it for that option to lapse. Now, of course, in practice, it may have no effect, because if you've sold the building and you never have anything to do with it ever again, having the option makes no difference at all. I mean, I could opt to tax the Shard. I could write to HMRC and opt to tax the Shard in London today. It would have no practical impact because I'm never going to do anything with the Shard. But it would sit there for 6 years and then it will be chucked away. Once you've gone past 6 months, you can no longer revoke an option until after 20 years have passed. But once 20 years have gone by, you can revoke the option. That's it. Within 6 months or after 20 years. That's when you can revoke an option. Okay, that's options tax completed. Let's move on. Supplies relating to property which are outside the scope of VAT. We're going to see this first one crop up again later when we talk about cross-border supplies. But the law says that services that are directly related to land and buildings are outside the scope of UK VAT if the land and buildings to which they relate are outside the UK. So, in other words, the service that is performed is treated as if it was performed where the building is located. So, if I'm a property agent based in the UK, and you tell me that you want to go looking for a business property or even just a home, a second home in, say, France, and you ask me to find a suitable property for you, and I'm also in the UK with you, and I find that suitable property, and I'm therefore allowed to charge you my fee for doing so, then for VAT purposes, despite the fact that I've never set foot in France to do this work, it's all been done virtually, that supply takes place for VAT purposes in France. So it's outside the scope of UK VAT. However, it is within the scope of French VAT. So because I'm a UK-based property agent, and this is a property in France, I've now made a supply of my services to you in the UK, which is treated as taking place in France for VAT purposes. I would have to register, I should register in France, and I should charge you French VAT. Because I don't have an establishment in France, I don't get the benefit of any VAT registration threshold that French businesses would get. So even if that's my only ever supply in France for VAT purposes, I've got to charge you VAT, French VAT. Now, I'm a property agent. I'm not a VAT expert. So I almost certainly won't realise that I have to register for VAT in France and invoice you French VAT. What I'll probably do is to invoice you with UK VAT. Can you recover that VAT? If I charge you that UK VAT, can you recover it? It's a yes or no. Thank you, Graham. Graham says no. A couple of no's. Yeah. Okay, fantastic. Thank you very much indeed. Everyone's got the idea. They're coming in for all angles here. So yeah, absolutely not. Why? Because it hasn't been correctly charged. This is fantastic because it means that you're retaining stuff that we covered a couple of weeks ago. And if you weren't here a couple of weeks ago, then and you answered no, that's really very impressive. Congratulations. We'll come back to how we account for the VAT later on. We're going to cover it in cross-border VAT later on. The other major land and building transaction, which is outside the scope of VAT, is where a landlord pays a reverse premium to a tenant to induce the tenant to enter into the lease. Sorry, Alan. Yes, no, a very good question, Alan. So if I charge you UK VAT and you realise that I should have charged you French VAT, then you should be disputing that VAT. So what I would do if I was you is I would pay me the net amount and I would dispute the VAT. I don't have to tell the supplier that they should be registered in France. That's their problem. But I should tell them they shouldn't be charging me UK VAT. The problem is, Alan, that most people won't realise what the law is, and they'll think that being charged UK VAT by a UK agent makes perfect sense. So they'll recover it, and they'll only discover that it shouldn't have been charged when they have a VAT inspection. And the VAT inspector will simply say, you shouldn't have been charged this VAT. I'm going to disallow it, so I'm going to assess you for it. Go back to the supplier and get it back from them. And as I said last time, the chances of actually getting that is almost impossible. Yeah, almost impossible. So you've got to dispute it when it's charged. But if you don't have the requisite VAT knowledge, then you'll just miss it. You'll just miss it. And if you're unlucky enough to have an inspection, it will be disallowed. So for the consequence for the supplier, well, HMRC doesn't really care that much because you shouldn't have charged VAT. You did charge VAT. So really you should be issuing a credit note for it and getting it back off HMRC, but they're not going to go pursuing the supplier because the supplier's paid the VAT over. So probably nothing actually, Sophie. And there's no way that, I don't think these days, maybe previously they would, I don't think HMRC would contact the French authorities and say, oi, we've got this agent here, he should have charged some French VAT. I don't think it'll go that far. Ian, a question in the Q&As. So this goes back to the option to tax. So what happens if you make an option to tax on a property, you sell the property with VAT, then you end up buying back the property after 10 years? Would you have to make a new option because the original one was disapplied? Yes, you would. Yes, you would. Because once you have no longer had an interest in that property for 6 years, your original option would lapse. So you'd have to sign a new option, which would then last 20 years. That's correct. That's correct. Good question, by the way. Very good question. Okay, the only time where a reverse premium would attract VAT is if it's not really a reverse premium at all. It's a payment made by the landlord to the tenant because the tenant has provided goods or services in consideration to the landlord. But if all that's happening is that the landlord wants me to sign a lease, so they pay me a lump sum to convince me to do so, then that is outside the scope of VAT because the tenant has received money, but they haven't done anything in return. They haven't made a supply of goods or services, and just agreeing to sign a lease isn't supplying services. So therefore it's outside the scope of VAT and no VAT should be accounted for. As I mentioned at the beginning of today, any supply which isn't 0 rated, 5% rated, or standard rated, by default is exempt from VAT. So I said first thing that the first grant of a major interest in dwellings, once they're completed, 0 rated. So any subsequent grant, exempt. Any grants of minor interests in dwellings, care homes, charitable buildings, exempt, because the law only talks about major interests. And the sale of a commercial building more than 3 years after it's been completed is by default exempt, unless the vendor has opted to tax their interest in that building. And the sale of bare land is an exempt supply. Charging rent is an exempt supply by default. Okay, a couple more things on property VAT, and then we're on to our look at cross-border VAT. So capital goods scheme, the capital goods scheme. This scheme operates whenever a property has been purchased or extended or renovated, and the works or the purchase price cost more than 250 grand plus VAT. So it doesn't matter what the work is, whether it's purchase, extension, or renovation. The key thing is that for that particular transaction, the cost is more than 250 plus VAT. So if I bought a commercial building for £1 million plus VAT, then that building, that purchase price, sits within the capital goods scheme, so is relevant for the next 10 years. If 3 years after I buy the building, I then extend it for £500,000 plus VAT, there's a new capital goods scheme that applies to the £500,000 for 10 years after that was incurred. So you can have lots of different expenditures on the same building, all falling within the capital goods scheme, but actually the 10-year window covers a different period of time. And as I mentioned earlier, what we're doing is reviewing the recovery of input VAT over a 10-year period. In the quarter, when we buy the building or we get the invoice for extending it or renovating it, we claim our input tax back based on the ratio of our taxable to exempt supplies in the quarter of the purchase. So just following normal VAT recovery rules. If I don't have any exempt supplies, I claim back 100% of that input VAT in that quarter. If I am partially exempt, then I have to make an annual true-up to my input VAT recovery based on any change in the ratio of taxable to exempt supplies each year. So if in year one, at the end of my VAT year one, your VAT year is either March, April, or May, depends on your VAT return period. So if in my year to March 2021, I bought this building sometime during that year, and by the end of the year, my total taxable supplies were 70% of the total, then I recover 70% of the input VAT of the building. If in year two, the taxable use goes down and the exempt use goes up, so that I'm only using it 60% in year two, I've got to make an annual adjustment to the input tax I recovered originally, because I recovered based on 70, and for the second year, I've only used it 60% for taxable use. So what I do is make an adjustment of 10% of the original input VAT divided by 10 years, because I'm making annual adjustments. So I don't make the full 10% adjustment, because in the first year, I did already use it 70% for taxable use. I've only used it for 60% in the second year, which is 1/10 of the total adjustment period. So my VAT adjustment is the difference between the two percentages divided by 10, based on the original input VAT. We'll see some numbers in a moment. But even if you are a fully taxable supplier, you don't make any exempt supplies at all. If you sell the building within 10 years of incurring the relevant expenditure under the capital goods scheme, then you have to make a final sale adjustment. And as I was trying to mention earlier, if you sell the building as an exempt supply, so it's a commercial building, for example, that's more than 3 years old at this stage, and you haven't opted to tax your interest in it, then you're treated as if for the remaining number of whole years out of the 10-year adjustment period, you're deemed that you would have used it 100% for exempt use. And that will result in a clawback of some of the initial input that you claimed when the expenditure was originally incurred. But if you sell it as a taxable supply, either because it's a commercial property that's less than 3 years old, or the vendor did opt to tax their interest in the property, then you'll be treated as if you were going to use it 100% for taxable use for the remaining whole number of years of the 10-year adjustment window. And if you've previously only claimed back part of the input VAT that you incurred, because you were partially exempt, but then you sell the building within 10 years as a taxable sale, a VATable sale, then that will enable you to claim back some additional VAT from the original date of purchase. So I said earlier that if my company bought an office building and used it entirely in our trade, which is taxable, we can recover all of the input VAT, at least initially. But if that office cost us more than 250 plus VAT, and we sell the office 7 years later, and we don't opt to tax before we sell it, we're going to face a clawback of some of that original input VAT. So what we should do is we should opt to tax and notify HMRC of that option before we sell the property, because then we can charge VAT on the sale and we'll be treated as if for the remaining 3 years of the 10-year window, we would have used that building to continue to make taxable supplies. So you can make an election, an option to tax at any time up to just before you sell it, just before you exchange contracts. You can opt to tax and notify HMRC. You've got to notify them. If you don't notify them, as we discussed last time, by the time you come to sell it, it's not a valid option. Katrina, do I still need to do a CGS adjustment if I sold it 9 years and 1 month after, because there's no whole years remaining? The answer, Katrina, is no, you don't. It's quite an extreme example, but I'm sure it may happen. If you sell the building 9 years and 1 day after you incurred the expenditure and recover the original VAT, there are 0 complete years left. So there would not be a final adjustment. That's correct. That's correct. Now, just an example dealing with the annual adjustment, and then an example dealing with the sale adjustment. And then we'll move on to have a look at transferring a building as part of a business as a going concern. And that will finish our look at land and buildings VAT over the course of the 2 sessions. So let's assume that you purchased a building, a commercial building, and you paid input VAT of 100 grand. And in the year, the VAT year, when you purchased that building, so in the year to 31st of March, in the year you bought the building, or 30th of April, 31st of May, depending on your VAT returns, your ratio of taxable to exempt supplies was 80%. 80% taxable, 20% exempt. And then in the second year, that ratio changed to 70-30. And then in the third year, it changed to 50% taxable, 50% exempt. Then in the first year, you would retain 80% of the VAT that you were charged. So you would claim back £80,000. But at the end of the second year, you'd have to pay back some input VAT based on the difference between the year 1 ratio and the year 2 ratio. So 70 compared to 80, so there's less taxable use. You have to pay back 10% of the original input VAT divided by 10. So actually 1% of the original VAT, which is £1,000. And then at the end of the third year, because your ratio has dropped to 50% taxable, in year 1, it was 80%, and that's when you claim back the 80 grand. In year 3, it's 50. So the adjustment is always made from year 1 to year N, the year you're in now. So the adjustment is 80 minus 50, 30% divided by 10, because year 3 is only one of the 10 years of adjustment, so we take 1/10. So 30% divided by 10, 3% of the original total input VAT. So the business will have to pay back a further £3,000. That's how the annual adjustment works. And you can make that annual adjustment in the VAT return to 31st of March, or the VAT return to 30 September, or the VAT return to 31st December. You can make that adjustment in any of those 3 returns, but you have to do it within 2 returns of the end of the VAT year. And just to reiterate what I was saying about a fully taxable business, if it bought a commercial building for £1 million plus VAT, then the VAT is part of the capital goods scheme. We have to reflect on our input tax recovery, our original input tax recovery, for the next 10 years. So if 5.5 years later, we sell the property for 1.3 million, if we haven't opted to tax the building, then we're going to sell it as an exempt supply, because it must be more than 3 years old now. We're selling it 5.5 years after we bought it. So if we sell it as an exempt supply, we are treated as if we would have used it for the remaining whole number of years of the 10-year adjustment period for exempt use. So if this is taking place 5.5 years later, there's 4.5 years left of the adjustment period. So we round that down to 4 complete years, and we would have to pay back 4/10, 40% of the original input VAT. So that if we don't opt to tax before we sell the building, it's going to cost us 80 grand in input VAT that we have to repay. If we opt to tax just prior to sale, and we notify HMRC just prior to sale, and by sale I mean exchange of contracts, not completion, then we would charge 20% VAT on the sale price. We would be presumed to use that building for the remaining 4.5 years for completely taxable use, which is what we've used it for in the last 5.5 years, and there will be no adjustment to the input tax that we had previously recovered. And that's what the next slide just confirms. Now, the new owner, if I've charged VAT on the 1.3 million, so I've charged 20% on the sale, the new owner has just bought a building for 1.3 million plus VAT. So they are now going to have to operate the capital goods scheme for another 10 years for them. So the capital goods scheme doesn't just apply in the first 10 years of the building's life. It applies any time that somebody spends money that falls within that scheme. That's the capital goods scheme. Finally, transfers of going concern involving buildings. It's not a simple rule, but it's a consistent rule. So once you've learnt it, and you don't tend to forget it. But it's actually really quite important. Now, I'm going to make a presumption that you understand that generally when you transfer a business as a going concern, and the purchaser is or will be required to become VAT registered, the transfer is usually outside the scope of VAT. It's not considered to be a supply of goods nor a supply of services. That still holds true when you transfer a business which includes a building, but you might have to charge VAT on the building element, not the other assets, just the building element. So if I'm making a transfer of a going concern, and by the way, that's not just, for example, a trade that happens to own a building. If I transfer a building, a commercial building, which is tenanted, it's rented out, that's a business. So if I sell that building to you, and those tenancies will continue, so you're going to carry on a property rental business, then I am transferring you a business as a going concern, and these rules will apply. So If the assets being transferred include land and buildings, we have to think about whether we have to charge VAT on the buildings, but nothing else. Now, the way we tell whether we should charge VAT, the first step is to say, if I was selling this building or this land without transferring the business, would I have charged VAT on it? So if this wasn't a TOGC, would I now be charging VAT on the sale of the building? Well, yes, but only if the building is less than 3 years old, or I've opted to tax my interest in it. If I wouldn't charge VAT on the sale of the building in isolation, so not as part of a TOGC, then I never charge VAT on it. Just because it's part of TOGC. If I wouldn't charge VAT in isolation, I'm definitely not going to charge VAT because it's part of a business. But if I haven't opted to tax this building and I sell it in isolation, that is an exempt supply for VAT purposes. But if I sell it as part of a business as a going concern, so the purchaser is going to carry on the same type of business I have, then it's outside the scope of VAT, which is a subtly different status to being exempt. Now, if I look at this building and say, right, if I wasn't transferring this business, I would have to charge VAT, then the default is I have to charge VAT on the building when it's being transferred as part of a business. But I then have to ask another question. Because if the purchaser opts to tax their interest in this building and they notify HMRC that they have opted to tax their interest in this building before we exchange contracts, and they can prove to me that they've done all that, then the transfer of the building will follow the same VAT rating as the rest of the business. It'll be outside the scope of VAT. Graham, I'll come back to your question in a moment. Apologies. So this is, I think, probably the only time where the purchaser's actions can change the VAT status for the vendor. Excuse me. So I've got this business that includes this building. So I'm going to sell you my training consultancy business, which includes this office building. You're going to carry on running a training consultancy business with it. If I've opted to tax the office building, I have to charge you standard rated VAT on the building, unless you can prove to me as the buyer that you have already opted to tax the building you're going to be buying from me. You've notified HMRC of that option. You have to prove all that to me. And if you can prove that to me, or probably actually my lawyers, my conveyancing lawyers, before we exchange contracts, then the whole transaction is outside the scope of VAT. Now, if the purchaser can't do this or demonstrate it before exchange, they will have to pay the VAT that I am correctly then charging them. And if they're going to be running a 100% tax, so if I sell you my business and you don't tell me you've opted to tax the building because you haven't, or you haven't notified it at least to HMRC, I've got to charge you VAT. But if you carry on running the business that I've been running, you'll just be charging VAT the way that I charge VAT. So the VAT I charge you, you can claim back anyway. You can claim it back anyway. So you might say, what's the big deal? I'll just be charged the VAT. Okay, there's a cash flow issue, of course. So I need to fund the full purchase price before I recover the input VAT in my next VAT return. But what's the big deal? And the big deal, as we discussed earlier, is that you would have unnecessarily paid extra SDLT because you would have paid it on the VAT inclusive price that I've charged you. Don't worry about the last point on the slide. It doesn't really have any practical implications that I've ever come across, or I think I ever would come across. So, a couple of questions. First of all, Graham, yes, sorry, slight delay to answer your question, but Ray, TOGC, does the building element include the transfer of a business property leased from a commercial landlord transferred to a limited company that I own? Yes, it does. If you're transferring the leasehold interest in a property to another party, which is going to carry on the same business as you, then that is TOGC, including the transfer of an interest in a building. So if you haven't opted to tax your leasehold interest in the building, then you simply don't charge VAT on the transfer of the business. But if you have opted to tax your leasehold interest, I don't know why you do that, but if you've opted to tax your leasehold interest, then you would have to charge that on transferring the lease to the company, unless the company opts to tax the same property and notifies HMRC and proves to you that they've notified HMRC before the deal goes ahead. And sorry, Graham, to clarify, this is an incorporated partnership, makes no difference. My answer remains the same, Graham. Enver, school-related VAT. If a school lets out its sports hall, it's standard rated, but if it lets out to group, okay, right, Enver, when you're renting out a sports hall, you are renting out sporting facilities. Because when you rent out a sports hall, it's not like a 5-year lease, is it? You rent it out for an hour or 2 hours or 5 hours or a day. That's not a proper, that doesn't grant the user an exclusive right of use of the sports hall. So what you're referring to, Enver, there is a specific exemption within Schedule 9 of the VAT Act that covers sporting facilities in certain situations. Let me just, as you mentioned it, I'll give you a reference so you can kind of look it up yourself. So it is, it's Group 10, Schedule 9, VAT Act 1994. So, Enver, what I would say is that that doesn't count as rent. That is the provision of sports facilities. And in Group 10 of Schedule 9 of the VAT Act, certain supplies of sporting facilities are exempt. Some of it is to do with how many sessions they use it for. So there's quite a lot of detail in there. But if you read through that group, then that will tell you all about it. But Enver, my basic answer to you is that isn't rent. In the traditional idea, that is not rent. That is the provision of sports facilities. It's different. Okay, are there any other questions on land and buildings VAT at this stage? Feel free, if you forget to ask something and it comes to you later, chuck it in later, but we're about to change direction somewhat. Okay, can't see any questions, but if they come up, I will, of course, address them. Right, let's move on to the cross-border supplies of services. The reason why I wanted to bring this up, and had we had time, I would have done so in the first session, is because I wouldn't say I get a lot of queries about this. I mean, I do get some, but whenever companies ask me to go in and do a sort of VAT audit for them, Ian, would it be possible to play back the recording? Would you mind? I apologise, but I need to sort of get on with it if I can. If that's okay, Ian. Yeah. If there's a problem with the recording for some reason, please let K3 know, and I'll get back to you. I'll get in contact and answer it for you. Okay. So whilst I don't get an awful lot of queries about this, when I go and do audits of companies, VAT audit, they ask me to come in and say, can you check we're doing VAT correctly? To which the answer is always no, you're not, because there's always something wrong. I always find that they don't always deal with all the aspects of cross-border services correctly. They're always making some kind of error when it comes to this particular topic. Jacoby, sorry, just seen your question. If a VAT registered beautician rents a room in her practice, does she charge VAT? Jacoby, I'm going to give you the traditional consultant's answer. It depends. If all she's doing is literally renting a room and she's not offering any other facilities, then if she has opted to tax her interest in the building, she charges VAT. And if she hasn't, that's an exempt supply. But if in that room there are facilities, there's equipment and facilities, so that a freelance beautician could just simply come in and ply their trade, then she's not supplying rent. She's supplying beautician type services, and she would have to charge VAT. So it all depends on exactly what's being provided here. If it's literally just a space, just a room, then no. But if there are all sorts of things available to her to use in her, sorry, for the person who's coming in, not her, for the person who's coming in to do the work, the freelancer, then that would likely be a standard rated supply of services instead. So it does depend, Jacob. I hope that makes sense. Right. Cross-border supplies of services. What's the problem here? The problem is, like most of VAT, the rules lack logic. There's no logic to them. So what I thought I'd start by doing is just highlighting the possible outcomes. But this predicates itself on having correctly identified where the service takes place for VAT purposes. And where the service takes place for VAT purposes is very rarely where the service takes place. In other words, where the activity is physically performed. That is very rarely the correct rule to work out where that service takes place for VAT purposes. James, you got your hand up. Was that just clicking the wrong button, I imagine? So, assuming that you can correctly identify the place of supply of the service, then these are the possible permutations and combinations of the VAT treatment. But before I just show you the slide, once you've established that the place of supply is a particular country, then it's that country's VAT rules which we apply. And if that's not the UK, then fine, there's no UK VAT, but something might have to happen from a VAT perspective in the country where the supply is treated as having been made. And then the question is, who deals with it? Does the supplier, it might be a UK supplier who's supplying this service, but it takes place for VAT purposes in another country. Does the supplier have to deal with the VAT, or does the customer deal with the VAT? So these are the possible permutations and combinations. Firstly, excuse me. Firstly, if it's a UK supplier and their customer is in the UK, then of course, if the place of supply is the UK, then they've got to charge UK VAT. But if the place of supply is another country, then the UK vendor, the service provider, should not be charging VAT. UK VAT, sorry. But they may well have to register in the jurisdiction where the service is taking place and charge VAT there, which we're going to talk about in more detail later on. If the supplier is a UK supplier, and the customer is a business customer in the European Union in particular, because they have identical VAT rules to us, then if the place of supply of that service is the UK for VAT purposes, then we just charge UK VAT. But the key thing is, if you are supplying a business customer, and we'll find out what that means later, but if you are supplying a business customer and the place of supply takes place where they are, then they deal with the VAT. Our invoice says we're a UK company or UK business, but this supply takes place in your country. It's outside the scope of UK VAT. It's up to the purchaser of the service to understand that they have to account for the VAT themselves. using what's called a reverse charge mechanism. Thirdly, if the supplier is UK based and the customer is not a business customer, and they are in they are in a European Union country, apologies. If the place of that supply is treated as being the UK for VAT purposes, then the supplier just charges UK VAT. Nice and simple. Even though the customer's abroad, if the service takes place in the UK, you charge UK VAT. But if the place of supply is the customer's country, then because they're not a business customer, we shouldn't expect them to have to account for any VAT in their country. They don't have to interact with the VAT authorities in that jurisdiction. So therefore, we, the supplier, have to account for VAT in that country. So that country's VAT rate on our service, and we have to make sure that that tax authority gets that VAT. We'll find out later that we can either do that by registering in that country and in each country where we make similar supplies, or we can simply choose an EU authority. I would take Ireland personally, and we can register in Ireland for the purposes of telling Ireland that we have made supplies to these European countries, to non-business customers, of this value in this quarter, and we owe these amounts of VAT to each of those countries. So I can use Ireland as a conduit to report all the VAT that I owe to European jurisdictions, because I've made sales of services to non-business customers in those jurisdictions where the place of supply is those countries. That's called the one-stop shop service, or OSS. We'll come to that again later on. Michael will be stopping just before 11 o'clock, okay? Now, what I also come across, and I came across in fact last week, I did a VAT audit in London last week. If the supplier is a foreign supplier and the customer is a UK business, if the place of supply is the UK for VAT purposes, then because the foreign supplier is supplying a UK business, then the UK business will deal with the UK VAT. Again, using something called reverse charge. So it means that if you have clients who receive services from foreign service providers and they are business customers, then the foreign supplier should expect the UK business, so your client, the UK business, should be applying reverse charge to that service. And a lot of times they don't, because they don't realise that's what they're supposed to do. Enver, the slides have been copied into the chat several times. You might have missed them, so I'm sure they'll be copied in again. Finally, if the supplier is abroad, is outside the UK, and they're supplying a UK non-business customer, then again, we can't expect a non-business customer to have to deal with the VAT authorities in the UK. They have no reason to. And therefore, in that situation, the foreign business has to register in the UK. If the place of supply of that service for that purpose is the UK, they've got to register here and charge the UK customer UK VAT. And being a foreign business that isn't established here, they're providing services remotely, they don't get the benefit of the £85,000 UK VAT registration threshold. And just an example of that is Zoom. So if you subscribe to Zoom to provide your sort of webinars, as K3 does, then Zoom sends you an invoice. Zoom is based in California. So when I use Zoom myself for my own online training, so when Zoom sends us an invoice, they know that we are a business customer because we've given them our VAT number. And that's proof, that's all the proof they need that we're a business customer. So they're a foreign business. We're a UK business. I can tell you that the place of supply of their services to us is the UK. So they don't charge us VAT. We deal with the VAT under reverse charge. But if you are a non-business customer and you have a paid Zoom account, the place of supply of those services is still the UK under VAT law. So Zoom has registered in the UK and it will charge those non-business customers UK VAT. Okay, excellent. Let's stop for our second and final break. When we come back in 10 minutes' time, we're going to have a look at reverse charge in more detail and spend much of the rest of the time discussing, I'm going to discuss with you, the place of supply of different types of services and the VAT implications that flow out of that. Welcome back. Our final session for today, covering the remainder of the cross-border services section. Just a question came in during the break. So Dev, how do I set aside an option to tax on the sale of the property? You just set it aside. I know it sounds a bit daft. You don't tell anybody per se, but if the purchaser says, can you set this option aside? And as the vendor, you verify that in those circumstances, you are permitted to, as I showed you earlier, and you agree to do so, you literally just set it aside for that transaction. Yeah, it's just for that transaction per se. So you'll need to follow the CGS rules if sold within 10 years of opting to tax. No, that's a slight misconception, Dev. You need to watch out for the capital goods scheme if you have incurred input VAT on the purchase, extension, or renovation of a property, which costs more than 250 grand plus VAT. You have to monitor the input VAT for the next 10 years. If you sell it under an option to tax, so you charge VAT on the sale, there can never be a clawback of the original VAT. But if you sell it within 10 years without an option to tax, so as an exempt supply, that is what's going to cause the clawback. Another question coming from Tom. If a UK VAT registered business supplies a service to an EU non-business customer, then the place of supply is the UK, I believe. Okay, Tom, that is correct, but only under the general rules on place of supply. There are special rules, which we're going to see shortly, which can shift that place, that general rule. It can shift with a special rule, the place of supply to the customer's country. So, Tom, what I say is generally you are right. The place of supply when you supply a non-business customer is the UK, but there are lots of special rules that can change that. And Stephen, the client has a UK company but moved to Switzerland with a view to permanently moving there to provide services in Switzerland, but invoicing to the UK company of the Swiss client. Okay. Stephen, if you don't mind, I'm going to cover that when we cover the topic here, because I am actually going to address that issue. What happens if your customer has more than one office? Who is your customer? So, Helen, just leave the question there for now, please. But I think I will address that, and you'll probably be able to work out the answer when we cover that particular part. So just hold fire, and we'll come back to it soon. Right, reverse charge. When does reverse charge apply? It applies where a service is supplied from a foreign supplier to a UK business customer, not necessarily VAT registered, but a UK business. It might be an insurance company, for example, that only makes exempt supplies. It might be a business which is trading at below the VAT registration threshold, so it doesn't need to register for VAT. So as long as it's a business customer, that's what counts, where the UK is the place of supply, which generally it will be. So when a foreign business supplies services to a UK business, generally the place of supply is the UK. So what reverse charge involves is the UK customer, having received that service, is deemed to immediately sell that service in the UK for the invoice value of the supplier, and then they're deemed to buy it back in the UK at the same value. So if the UK customer is VAT registered, or should be VAT registered, I should say, then they are required to account for output VAT on the service they received in box 1 of their VAT return. If they're not VAT registered, because they make exempt supplies, or they trade at below the VAT registration limits, then because they're deemed to sell this service in the UK, they have to add the value of that service they received, that foreign service they received, to the value of their actual UK taxable supplies. And if that takes them over the VAT threshold in the last 12 months, then they have to register for VAT. So that registration process will take a month or so to sort out. So for that service they just received, they don't actually have to account for any VAT, because when they received that service, they weren't required to be VAT registered. So they just receive it completely VAT free. But if they add the value of that service to their own UK taxable supplies in the previous 12 months, and it takes them above 85 grand, they've got to register prospectively. So the next invoice they get in from a foreign supplier, they'll have to account for output VAT on it. It's that last point that a lot of businesses miss. Okay, it's that last point. Walter, you're quite right. It does take a long time to get the VAT registration sorted, but you have to apply to be registered by the end of the month following the month in which you breach the limits. And your effective date of registration is the first day of the month after. So no matter when you actually end up with your VAT registration number, you have to apply for registration within 30 days, certainly by the end of the month following the month when you breach the limits, and then you're deemed to be registered for that from that point onwards. So once you get your VAT number, you have to go back and issue VAT invoices for all the supplies after your effective date of registration. Now, let's take an example of an insurance company. So if your client is an insurance company, they only make exempt supplies. If they receive foreign services in any 12-month period of more than £85,000, then they're deemed to make UK taxable supplies of more than 85 grand, and they have to register for VAT. They have to register for VAT. And once their effective date of registration has been established, all invoices they receive from foreign suppliers thereafter, they have to account for output VAT in box 1. They owe that money to HMRC, but because they're using those services to make exempt supplies of insurance, they can't recover that VAT in box 4. So they end up having to pay over VAT, UK VAT, on the foreign services they receive. And frankly, that's the whole point here. That's the whole point. If they'd used a UK service provider, they would have paid that UK service provider UK VAT, which they wouldn't have been able to recover. So we don't want them to be able to avoid VAT just by using a foreign service provider. So if the amount of services they get abroad, from abroad, are more than 85 grand, they have to register, and it puts them in the same position they would have been in had they used, from a VAT perspective, had they used a UK service provider. But if they are an exempt supplier and their foreign services are less than 85 grand in any 12-month period, then those foreign services represent the only UK deemed tax or supplies they ever make, then they're never obligated to register. And they actually get those foreign services VAT free. So an exempt business that has foreign services of less than 85 grand a year doesn't have to register, and they never pay VAT on those services. If they used a UK service supplier, they pay VAT. So it's cheaper to use the foreign one. Or if your client is a smallish business, it does have taxable supplies, but its taxable supplies are only 50 grand a year. So its actual sales are 50 grand a year. It's allowed to receive foreign services of up to 35 grand a year, to top it up to 85 grand, up to 35 grand a year in a 12-month period, and it doesn't need to register for VAT. And it gets those foreign services VAT-free. So there is VAT to be saved sometimes by using foreign service providers. Katie, if the UK VAT registration business supplies guard services to an EU country, Ireland, what would be the VAT shown on the invoice? So Katie, we will cover this in more detail later on, but what I think we're going to find is that there is no special rule when you are supplying a business in a country, a business customer with people, so guarding services, then the supply generally, if you're supplying a business customer, takes place where the customer belongs. The customer in your example, Katie, is in Ireland, and therefore there should be no VAT shown on the invoice. None. It's up to the customer in Ireland to apply a reverse charge to that service. Okay, I'm going to clarify that point very shortly for you, but that's the answer to your question. Jacoby, yes, of course you opt to register for VAT if your supplies are less than 85 grand, but why would you want to? Why would you want to? So yeah, you can. Can you voluntarily register if your foreign services are less than 85 grand? Yeah, you can. But then you've got to account for VAT on them. And having registered for VAT, you've got to charge VAT on your own services, your own sales as well. So I don't quite understand why you want to do that, but I'm sure there must be a good reason. Roseanne, how can we explain to our clients who have no sales the purpose of reverse charge? I presume that is because that's because they receive foreign services of more than 85 grand a year. Is that correct? Yeah. So the reason why we're doing it is that if they used a UK supplier, service provider, that UK service provider would charge them VAT, yes? And if they're not making any sales, they have no economic activity, can they recover that VAT? Possibly. So if they can recover that VAT, then what it costs them is the net amount the supplier is charging them. If they're receiving the service from a foreign supplier, then they do have to charge themselves VAT in box 1, but they also claim back that VAT in box 4, and it puts them in your example, in the same position as if they had used a foreign supplier. Sorry, a UK supplier, apologies, a UK supplier. But the reason HMRC makes you jump through those hoops is just in case you couldn't recover all of your input VAT incurred. In their case, they can, so it's just a paper chase. It's just putting the same numbers in. I think if I was to answer them, I'd say because the law requires it. If they want to comply with the law, they have to do it, Roseanne. Logically, it's VAT. Where's the logic of VAT? So it's a tricky one. I have to say, it's quite tricky. Amit, if my website is designed by a company in India, am I correct to say that I have to account for output VAT and claim input tax under reverse charge rules? Yes. Do the same rules apply if I'm outsourcing my bookkeeping services, I presume to India again? Then the Indian business is supplying services to the UK business. We'll see soon there's no special rule about accounting services or website services. So if a supplier is supplying a business customer, generally speaking, that supply for VAT purposes takes place where the customer belongs. That's you, and that's the UK. So you have to apply reverse charge to those services. Quite correct. Okay, back to the slide. Stephen, I haven't forgot about your question, by the way, it's still there. So the reverse charge, if the UK customer is VAT registered, they have to charge themselves output VAT in box 1. If they're not VAT registered, because they're below the registration threshold, they add the value of the foreign services to their own turnover in determining whether they have to register for VAT. Having been deemed to sell that service in the UK, they're then deemed to buy it back. So therefore, they can claim back the input VAT in box 4 of the VAT return as appropriate, based on their percentage of taxable sales and so on. So as I pointed out earlier, just earlier to Roseanne, if your client is a 100% taxable supplier, or in your case, they make no sales at all, then the figure in box 1 will be the same as the figure in box 4. And so it has no actual VAT impact. And that's quite important, by the way, because if your client hasn't been doing this reverse charge stuff, but they would be entitled to recover 100% of their input VAT, then they just have box 1, box 4, the same number. So their VAT net liability every period was correct. The box 1 number was wrong, the box 4 number was wrong, but because they were the same number for this foreign service, their overall VAT liability is correct. So they cannot be penalised, because the VAT penalties are based on the amount of VAT you have underpaid, and they haven't. Now, you don't apply reverse charge in the UK if the supply would be exempt in the UK or 0 rated. So in other words, put it very simply, if a UK supplier would not charge you VAT, you don't apply reverse charge to a foreign provider providing the same service. So if we were to arrange our business insurance with a Channel Islands insurance company or an American insurance company, and they were to insure us, if we used a UK insurance company, they wouldn't charge us VAT because they make exempt supplies. So when we get our insurance charge from our American insurer, we don't reverse charge because it's not a standard rated supply. So if it's 0 rated or exempted, we don't apply reverse charge. Now, to get to Stephen's question earlier, which I'll repeat once we've covered this, there are different rules that can potentially apply depending upon whether your customer is a business customer or a non-business customer. If the customer is VAT registered, they are always treated as a business customer. Always treated as a business customer. Even if they are receiving a particular service for a non-business purpose. Now, I have come across quite a lot. I deal quite a lot with companies that supply medical services. So hospitals are not businesses per se, because they have a statutory duty to treat patients under the NHS. But virtually every NHS trust is VAT registered, because they actually do make some taxable supplies. They charge you for car parking. They charge you for catering sometimes and whatever else. So the fact they're VAT registered automatically for this purpose makes them a business customer. But of course, they can be in business even if they are not VAT registered. So we just have to have sufficient evidence that they are a business customer and that they are receiving the supply we're making to them for business purposes if they're not VAT registered. An insurance company is a business customer. Everybody accepts that, but it's not VAT registered. A non-business customer is one that isn't a business customer. It doesn't have a definition. It's just any customer that isn't a business customer. Now, what we also have to understand is where the customer belongs. And this is getting to the question I had earlier. Where does the customer belong? And what if the customer, or even the supplier, has businesses in different jurisdictions? We have to work out which business is supplying a service to which customer. Now, generally speaking, we follow the contractual agreement. So Stephen's question earlier, just to remind you, and in fact, I'm going to just copy it and put it into the chat so you can all see it in the chat. So the client has a UK company, but moved to Switzerland. So the client lives in Switzerland and provides services in Switzerland. I presume that means you perform the work in Switzerland, but invoices a UK company of the Swiss client including a charge for 20% UK output VAT. So the UK company is clearly VAT registered in the UK. And what's the correct VAT position? So the problem here is that the customer has a Swiss base and a UK base. Now, where the work is performed, frankly, is neither here nor there, generally speaking. Sometimes it is, but very rarely. The fact is that that company only has one base. The supplier has only one base, which is the UK. That's where it's kind of registered. Now, the Swiss customer has two operations, one in the UK, one in Switzerland. First question would have to be, who are the contracts between? So is the contract between the UK company and the Swiss company, or the UK company and the UK operation, the UK company, the UK subsidiary of the Swiss company? And if the contract is between the UK company and the Swiss company, then generally speaking, the customer is in Switzerland. However, we change that default result. If the Swiss parent company has simply said to the UK company, you will contract with us, but you will go to the UK company and they will tell you what they want doing. If the UK subsidiary of the Swiss company is the one that's telling your client what services they want to receive, then that is the business customer in this transaction. And that will be kind of UK to UK supply, and 20% VAT should be charged. But if the Swiss parent company has contracted with your client and has said, this is what we want you to provide to our UK subsidiary, but you are working for us, you're contracting with us, you're invoicing us, then that supply takes place in Switzerland. And therefore, Swiss VAT needs to be accounted for. Switzerland isn't part of the EU, but it does have a reverse charge procedure. And therefore, we'd probably invoice the Swiss client with no VAT, no UK VAT, and tell them to apply reverse charge. My only slight concern with the scenario is the fact that your client is living in Switzerland. Does that create a permanent establishment for the UK business in Switzerland? And if so, that business might be required to be registered for tax, let alone VAT, but for tax in Switzerland. But that's another matter. Okay, let's move on. Really, the final thing that I want to discuss with you of any significance today is how you determine the place of supply of a service for VAT purposes. Now, as I mentioned, there are special rules for certain types of services, but where those special rules don't operate, then we default to the general rules. And I can't, somebody asked, or somebody made a point about the general rules earlier. I don't remember who it was, I apologize. But the general rule is that if your customer is a business customer, whether they're VAT registered or not, they're a business customer, the service you supply is treated as being supplied where the customer belongs. Where the customer belongs. But if your customer is not a business customer, then the default treatment is that the service is treated as being supplied where you, the supplier, belongs. So we have these two different, completely opposite general rules. And the reason why those rules are what they are, logically, we actually have some logic here, is that if I'm supplying a business customer in another country, I really don't want to get involved in their VAT system if I can possibly avoid it, because that's just more admin. So if they're a business customer, I can invoice them. If the place of supply is their country, then it's their country's VAT that applies. Then I can say to them, you deal with the VAT. You're a business there, you deal with it. But if I'm supplying a non-business customer in a foreign country with a service, again, we can't expect a non-business customer to deal with any VAT on services. It's ludicrous. They're not involved in the VAT system per se. So therefore, the default rule is that my supply takes place in the UK, so that I can simply charge them UK VAT. And that's easy. Because the alternative is that if that supply takes place in their country or another country, I'm going to have to, as a business, a UK business, somehow account for VAT to their tax authority. Because as a non-business customer, we can't expect them to do that. So these default rules just make life a lot easier. But they only apply where there aren't any special rules. But there are lots of special rules. Now, these special rules, you will find them in the legislation. If I just get the reference again. You'll find them in the legislation in, I think it's Schedule 4A. I'm just going to double check that for you. Yeah, Schedule 4A of the VAT Act. Okay, Schedule 4A of the VAT Act. Let me just type in the chat so you can write it down at your leisure. Now, what are these special rules? There are three groupings of special rules. The first set of special rules, it doesn't matter whether your customer is a business customer or a non-business customer, these are the rules for these transactions. Firstly, the one we covered earlier, supplies of services that relate directly to land, they are treated as taking place where the land is situated. That covers construction services, it covers repair services, it covers property valuation services, it covers conveyancing lawyers services, and property agents services. But it wouldn't include our service of preparing a set of accounts or some sort of tax return because they have property in a foreign jurisdiction. That's not a service that directly relates to land. What you're doing as an accounting or tax service is an indirect service. But if you are a conveyancing lawyer and you are conveying a foreign property, then your service takes place in the foreign country where the property is located. Now, if you're supplying a business customer with these services and the land is in, say, France, and the customer is a French business, it's possible that you would apply reverse charge. So they would account for the VAT themselves. But in some jurisdictions, they don't allow you to apply reverse charge to property transactions. So our law would say reverse charge is fine, but other countries may be different. And it may be that notwithstanding the customer could apply reverse charge, the supplier might still have to register in that country and charge VAT on a land transaction. Secondly, admission to an event takes place where the event takes place. And I, many years ago, used to work at BPP, the training company, and used to get queries all the time from students who were booked on things like revision courses. And these are foreign students, they live abroad, saying, why are you charging me VAT when my company is based abroad and you're invoicing my company? And I had I mean, it was a fax back then, there was no email. But back then I would have a standard fax prepared that said, the reason we're charging you UK VAT is that you are attending an event for which we're charging you in the UK. So the supply takes place in the UK, we have to charge you UK VAT. Don't worry about passenger transport, it's not particularly important. Short-term hiring of a means of transport. Now, when it comes to car hire, that means less than 31 days. So anything up to 30 days. And when it comes to hiring a vessel, a boat, it's anything up to 90 days is short term. And the place of supply of that service of boat hire or car hire is where the transport is put at the customer's disposal, where they pick it up from. It doesn't matter basically where they use it, but if they use it outside the UK, then we treat it as being supplied outside the UK. So if you were to hire a car in the UK, but drive it around Europe, only a very small part of the hire charge takes place in the UK, and therefore only a small amount of VAT should be charged. Most hire companies haven't got the faintest idea about that. Restaurant catering services is where the supply is performed. When we were part of the EU, there was another special rule which no longer applies to us, which is that EC onboard restaurant and catering services are supplied where the journey began. Now, this has affected people like Eurostar. So prior to Brexit, Eurostar, when they were traveling from St Pancras to Paris, for example, or St Pancras to Brussels, their onboard catering, they would charge UK VAT on the whole journey from St Pancras to wherever they're going, and they would charge French VAT on the whole journey back from France to the UK, irrespective of whereabouts you were when you bought the catering. Since we left the EU, we can't use that. So now restaurant and catering services are supplied where they're performed. So as soon as the train crosses the border, Eurostar has to start charging the other country's VAT on its catering supplies. And I haven't found out yet how it works. I haven't taken the Eurostar since Brexit, but I'm dying to do so. And I'll just spend the whole journey sitting in the catering car watching how the VAT works. That's how I roll. I don't know how they actually do it, but that's what they should be doing. And number 7, the hiring of any goods. If you rent goods, to the extent that you use them outside the UK, they are treated as if they were supplied. Sorry, the hiring service is treated as taking place outside the UK. Now, that's a UK rule. The EU law for EU countries says that we only have this special rule if the hiring takes place outside the EU. Now, that's quite important. Let's say that you were going to hire some, well, let's say that K3 Hub was going to hire some equipment. And the reason it was hiring some equipment is to attend an accounting and tax conference or exhibition in Paris. But they're going to hire the equipment for the stands in the UK, because then there's no language problems. Assuming that K3 Hub tells the hirer that they're going to be using that equipment in Paris, then that supply of hiring services takes place in France from a UK perspective. It's outside the UK. So the hiring company should not be charging VAT, UK VAT. And if they do, that would be wrong, and K3 Hub would have no right to recover it. The question is whether the hirer should be charging French VAT. Because from a UK VAT perspective, the supply takes place in France. However, because France is a European Union country, its law never changed because it didn't Brexit or didn't Frexit. And therefore, its law says there's only a special rule if you use the hired goods outside the EU. And K3 Hub will be using those hired goods in France, in the EU. So they don't have a special rule for this situation. So the French tax authority looks at the transaction and says, well, it's hiring of goods, but it's being used in the EU. So there's no special rule here. And therefore we default to the general rule. The customer, K3 Hub, is a business customer. And so we think that supply takes place in the UK because that's where K3 Hub is based. So we end up in a situation where the UK authorities say that supply takes place in France, and the French authorities say that supply takes place in the UK, which means that neither tax authority wants to collect any VAT on that supply. It is completely VAT-free. And whenever you see in my notes that I've crossed out EU and put UK, that black hole opens up and nobody wants VAT. It's bizarre, frankly, it's bizarre. Alan, you put a question in the chat, that's fine. So where is a webinar supplied if it's broadcast in the UK but watched outside? Alan, hold that thought. We're going to cover it momentarily. Hussein, does the hiring company require evidence the customer will use the equipment outside the UK? Yes, it does. Yeah, the hiring company has to get evidence from K3 Hub that they are going to be using this hiring equipment outside the UK. Correct. There's no standard format of what that evidence must look like, but there must be reasonable evidence. Now, those are the special rules, irrespective of whether the customer is a business customer or a non-business customer. There are another set of special rules, only a couple of them, where the customer is a business customer. And for one of them, electronically supplied services. The UK law says that supply is made where the service is effectively used and enjoyed. And what's an electronically supplied service? It's any service that relies on the internet for, and it's not just its delivery, it should say it's automatic delivery. Okay, it should say automatic delivery. Oh, sorry, I'm trying to write with a mouse with my left hand. Sorry, my right hand, and I'm left-handed. So that's a pretty poor combination. Automatic. Now, for example, what I'm doing here today is not an electronic service. You are not just paying and then just downloading something. It's a live event. This is a training service. This is not an electronic service. But Alan, if it was a webinar, so it was a pre-recorded webinar and you had to pay to view it, that would be an electronic service. And if the customer is a business customer, then the service is supplied where they are effectively using it and enjoying it. So if I recorded a webinar on VAT because a client wanted their staff to look at that recording, and the client is a UK company, but 70 of their staff are in the UK and 30 of them are in America, but they're all required to watch it, some sort of penance, then only 70% of my service is treated as being supplied in the UK. The other 30% is treated as being supplied in America. So we would only supply 70%. Sorry, we'd only charge VAT, UK VAT on 70%. Now, trying to find out where your service is enjoyed is almost impossible. Because even if you can get the IP address of the person that's viewing it, they could be using a virtual private network, which could be telling us they're in a different country to where they actually are. So I've always advised my clients that this is impossible to police. So I would just go along with where the customer is based. Ali, if a client is UK-based, UK VAT-based, UK VAT registered, but provides a recruitment consultancy service to the US, to a USA business customer using Zoom services, is that a zero-rated transaction? Ali, it's definitely not zero-rated. Okay, it's definitely not zero-rated. There's no question about that. There's no way that recruitment services are ever zero-rated. You won't find them ever mentioned in Schedule 8 of the VAT Act. So please don't use the phrase zero-rated. It does get confusing if you do that. Now, I think what you're asking is, where does that supply take place, for VAT purposes? Well, there is no special rule for recruitment services. So it follows the general rules. So if my customer is in the US, then my supply takes place in America. So my supply is outside the scope of UK VAT. It has nothing to do with UK VAT. And it will be up to the American customer to do whatever needs doing in America. But you'd have to check the American sales tax laws to work out whether you might have any obligation there to register for American sales tax. Thank you, Ian. Ian, you should already put that in the chat, actually, because that's something that everybody can benefit from. So I'll do that now. You're not to know that, by the way, so don't worry about that. I'll copy it now. Ian just messaged me to say that the implementing regulations are of great assistance in determining where a customer belongs. Okay, so thank you for that. Keith, does the provision of mobile apps count as electronically supplied? Absolutely. Yep, mobile apps is a classic example of an electronically supplied service. Absolutely right. Yep, it's probably the most common example of an electronically supplied service. Yep, mobile applications, definitely electronically supplied. There's another special rule for businesses where the service being supplied is transport and ancillary services. And also another special rule, if a company is providing repair services to an insurance company, the law says that if that takes place wholly outside the UK, used to EU, outside the UK, it's treated as taking place, supplied where it takes place. So if I need some goods moving from Belgium to France, and I ask a UK haulage company to do that for me, because the journey is completely outside the EU, the goods move completely outside the EU, the UK, apologies, that supply takes place outside the UK. The haulage company must not charge me UK VAT. But under the European VAT law, there would be no special rule because the journey is within the EU. So they would say, well, that service takes place where the customer belongs. I'm a UK customer. So France and Belgium say it takes place in the UK. The UK says no, it takes place in France and Belgium. And again, nobody wants any VAT, the VAT black hole. Now then, there's a whole load of services which when supplied to non-business customers have special rules. There's loads of them. How many are relevant to you? I don't know, but there's a whole list of them. So supplies by intermediaries, the supply takes place for VAT purposes where the underlying transaction takes place. So example, you as an individual are looking to acquire a painting and you contact an agent, a specialist, to find you that painting and try and convince the current owner to sell it to you. The agent finds the painting in America and convinces the owner to sell it to you as an individual, private individual. They do that all online. They don't step foot in America. The sale of the painting to you takes place in America because it's a sale of goods, and a sale of goods takes place where the goods are dispatched from. So that takes place in America. So the intermediary services also takes place in America because you are a non-business customer. If an intermediary is supplying their services to a business customer, there is no special rule. This list is for non-business customers. So an agent supplying services to a business customer, it follows the general rules. So that agent's services to a business customer takes place where the customer belongs. Transporting goods for a non-business customer takes place pro rata to the distance covered in each country. So if you decide as an individual to move house to Romania and you get a UK haulage company to move all your household goods by road to Romania, then that haulier supplies you with services in every country it passes through to get to Romania. It's about 6 or 7 countries. And they would have to register for VAT and account for VAT in each one of those countries that journey passes through. Thirdly, ancillary transport services. If the transport company, for an extra fee, offers to pack the goods before they go and unpack them at the other end, they charge a separate fee. That's one of the very few services where the rules say it's performed where it's performed. It takes place where you actually do the work. Also, if somebody either carries out valuations of or actually works on, repairs movable assets, then that supply also takes place where the work is performed. If it's immovable assets, that's land and buildings, and we already had a rule for that before. If they're working on immovable assets, land and buildings, then that takes place where the land and buildings are located. Cultural, sporting, scientific, educational, entertainment services, where they're performed. So if you decide privately to invite Beyonce to sing at your child's wedding in the UK, Beyonce is American, she's an American performer, and she flies over specially to sing at your daughter's wedding in the UK, then her services take place in the UK. And she would have to register and charge you 20% VAT. Unless you act for car hire companies, I'm going to skip over number 6 because because it rarely come across it. But as somebody asked before about electronically supplied services, about mobile phone apps, this is the big one, that when you supply electronic services to foreign non-business customers, your supply takes place where they belong, where the non-business customer belongs. So I can't remember who asked the question earlier. No, I forgot. No, I can't remember. Sorry, I apologize. Somebody asked about mobile apps. So if your client is selling mobile app downloads to individuals in 5 or 6 or 7 European countries, their supplies take place in those countries for VAT purposes. And what they would do is register, I would recommend, they register with the Irish VAT tax authorities to use their one-stop shop service. They're not VAT registering in Ireland. They're registering to use Ireland's one-stop shop service. Every quarter, calendar quarter, they would file a return that says, during this quarter, I sold downloads to non-business customers in France, Germany, Belgium, Holland, Latvia, Lithuania, Bulgaria, Estonia of this value. Here's the rate of VAT that applies to those sales in those countries. So here's the VAT I owe each of those countries. And you would then, I'll come back to that one in a moment. And then you would pay the Irish authorities the total VAT you owe to those jurisdictions, and Ireland would distribute it to them. Ian, the reason why I say Ireland is that all their websites and all of their telephone services are in English. That's why. If you want to register for Moss One-Stop Shop in France, feel free to do so, but you'll be filling out the forms in French and speaking to their authorities in French. Okay. Katie, sorry, the question. Yeah, VAT on those invoices show no VAT rather than zero rated. That's correct. Yeah, you shouldn't show them as zero rated supplies. You should show them as outside the scope of UK VAT. If you were using Sage, then you'd call it code T9. If you were using 0, I think you just have no VAT. Yeah, you just say no VAT. Cool. Onwards. There's still more non-business customer services which are treated as taking place outside the UK. Most of them you will never come across. One of them you almost certainly will, which is number 4. That if a business supplies consultancy services, engineering services, lawyers' services, accounting services, and similar services, that includes tax services, then if they're supplying a customer, a non-business customer outside the UK, they don't charge VAT because the supply takes place outside the UK. Because the Europeans haven't changed their law, only we have, the European authorities don't want any VAT either. So it's just completely VAT. Another one of these black holes, completely VAT-free. So we can now say that as a general principle, whenever you as a business invoice, if you're accountants or lawyers, whenever you invoice clients, whether they're business clients or they're individuals outside the UK, you never, ever charge them a UK VAT. Keith, yes, the one-stop shop does cover all EU member states. If the customers are outside the EU, you have to speak to the relevant tax authority of that jurisdiction on how you deal with it. But you'll probably, Keith, you'll probably have to register in a non-EU country and account for VAT locally there, I suspect. But I honestly, I don't know the answer because I haven't dealt with non-EU countries in that context. If you supply banking services or insurance services to a non-UK, non-business customer, then your supply of those services takes place outside the UK as well. So rather than being exempt, it's an outside the scope supply instead. The next couple of slides just talk about the accounting example I just gave you. You've got a French client. If they're a personal tax client, you're filing a UK self-assessment tax return for them. Prior to Brexit, so prior to January 21, you would have had to charge them UK VAT. But since January 21, you don't. Since we changed our VAT law, you don't charge them VAT anymore. And the French don't want any VAT either. It's the famous black hole that I've been referring to over the last 10 or 15 minutes. The next slide talks about the one-stop shop system, MOS, the mini one-stop shop system, as well as Ireland. Malta also has their tax services in English, so you could use Malta if you, it doesn't really matter. Yeah, just register with an EU authority and you can account for all of your EU VAT that you owe because you sell services which take place in European countries where your customer is not a business customer. Okay, let's move on. VAT suffered in other European countries. Prior to January 21, we were part of the EU refund mechanism, which meant that as a business, if we incurred input VAT in a European country, we could make a refund claim via HMRC. We would register with HMRC to recover that European VAT. We'd send them a schedule every year of the expense we'd incurred, the date and the amount and the VAT in each European country. We'd send it to HMRC electronically, just press a button and submit it. They would transmit that to the other authorities concerned where the VAT had been incurred, and they would check the claims. And as long as they were happy, they'd refund the VAT to the UK business directly within 4 months of submission. But since 2021, since we left the European Union, we can't participate in that mechanism. We can still recover relevant VAT we've suffered in a European country, but we can only do it by going to the tax authority website of that country and downloading their relevant claim form or filling it in online and submitting it. And it will be in the language of the country where the tax authority is based. Whereas in the past, we just used HMRC and everything was in English. And we just simply filed one return that said we've suffered this VAT in France, this in Ireland, this in Germany, this in Bulgaria. We just send the return in like that. Now we have to apply separately to each country where we've incurred that VAT. And you may find now that the cost of actually doing that exceeds the benefit of the recovery. It may not be worth doing, whereas in the past, it was a bit of a no-brainer. One final thing I want to mention, which is not services, it's goods, but I think it's worth just reflecting on. If your client is VAT registered and they import goods from outside the UK, they are permitted to account for the import VAT on their VAT return. They no longer have to pay import VAT to customs and then claim it back. The way they do that is on the import declaration, they declare that their payment method is G. The payment method is G. And then every month, HMRC will send them a list of all the goods that they've imported with the appropriate values for VAT purposes. And they simply account for output VAT on the next VAT return in box 1. And that's declaring the output VAT. Sorry, that's declaring the import VAT to HMRC. We owe you this money. But then you can claim back that VAT as relevant input VAT if you're using those goods in a VATable, in a taxable business. You still have to deal with the duties, either by paying immediately or by what's called a duty deferment arrangement. But the VAT side of it, you haven't got to physically pay to HMRC anymore. You can deal with the import VAT purely through the VAT return. And that is a very major cash flow benefit, because oftentimes you have to pay the VAT to customs before you had the opportunity to recover it through your VAT return. Okay, well, we'll stop at this point. That was the last slide that we had down to cover for today. Obviously, in the time we have available, we cannot cover absolutely everything there is to know about VAT in these areas, but I can tell you we covered a hell of a lot of ground in the 2 sessions that we've had so far. I hope that with the knowledge you've gained, and you can obviously rewind it, listen to it again, hopefully you can use this as a resource and feel much more confident about the VAT advice that you give, or even it may make you confident enough to give VAT advice when previously you may not have been prepared to do so. I hope so. Yeah, I do hope so. I hope that you can leverage value out of spending your 3 or 6 hours with me. So I hope it's been useful, and I'll look forward to maybe seeing you again on another occasion in the future. Heather, there are no slides. There are no notes. It's just slides. Okay, this is the material.